mortgage markets, and more, and welcome to Friday, everyone. I'm your host, Peter D'Angelo, and I hope you all had a wonderful start to the month of April. I have your real estate market update today, and I thought there's a lot of conversation and there's a lot in the news about the National Association of Realtors settlement and what the implications are for the practicality of how business will be conducted moving forward. Now, these changes are scheduled to be enacted in mid-July of this year. It's a pretty tight timeline that's subject to change, and it could, but for now I thought we gathered together at Guaranteed Rate a good list of questions that give us a good indication as to how things are going to practically be done when these changes do take effect. So we're going to go down the list of different questions that hopefully will be illuminating for you. If you're a real estate professional, it will illuminate a little bit more on how business can and will be conducted moving forward. And if you are a prospective home buyer, this is important to know as well, because you are now going to be well informed as to what it will be like shopping as a prospective home buyer after these changes take effect. So the first and foremost, the top question is, how will I know if there is a buyer's agent commission to be paid? I, being the mortgage lender in this scenario, we are going to collect a signed agreement that lets us know that there is a buyer's agency agreement in place, and that will also indicate for us what the commission is for that agent representing our borrower and the prospective buyer in that transaction. So we're going to document it and verify it. Not unlike everything else that we do in the process. It's going to be now, instead of just strictly asking for the purchase contract, we're going to also ask for the buyer's agency agreement and or commission schedule so that we know what the commission is that is to be paid out on that transaction for the buyer's agent. When we finally reach this point where it's going to be on the buyer to make payment to their agent for their commission, we will still need to verify the source of funds. So the money that's being used for down payment, closing costs, prepaids, they're now going to include buyer's agency commission. So we need to ensure that the borrower has enough money to cover all of those costs, and we will verify them through our conventional standard means by way of gathering bank statements. We do offer an automated verification system at Guaranteed Rate that's super slick. So that would be essentially the ways that we would go ahead and verify what we need to as far as the assets are concerned. If a purchase contract doesn't state who's paying the buyer's realtor commission, what additional documentation will we need to determine if the buyer is paying for the real estate agent's commission? We're going to ask for that buyer's agency agreement. There should be a signed letter that states who the representation is and how much they are to be paid. So we're going to gather that document, and that is what we're going to use to verify who is being paid and how much they are going to be paid and what that cost will be to the buyer at closing. How will a buyer paid realtor commission fee impact APR? All right, before we go into the answer for this, let's establish what the APR is. Let's say you're getting a mortgage and your interest rate is, let's say, 7%. If you take a look at your mortgage documents, you're going to see 7% as your mortgage rate, and you'll also see APR, and that number is going to be likely higher, definitely higher than what 7% is. Now, that's not what your interest rate is. You could think of the APR as like a thermometer outside, right? The thermometer doesn't affect the weather. It's just telling you what the temperature is. APR is like your barometer or your thermometer to let you know what the cost of financing is. Normally, if you have a 7% interest rate and your rate is locked in and your APR is, let's say, 7.19, that 0.19 is a way that we're expressing to you as part of the percentage rate. We're expressing to you what your cost of financing is. So because the difference between 7%, your actual interest rate, and 7.19% in this scenario is 0.19%, relatively speaking, that's low-cost financing. You're not paying a lot of fees that are associated, that are calculated in with the APR. Now, you could still be paying a lot of money if you have, let's say a high tax amount that you need to pay at closing, or your insurance premium is very high. They could be in there, but the APR is only a collection of the costs and fees. So now to go back to this question, how will paying the buyer's agency commission affect the APR? The answer is it won't. So the APR is exclusively finance charges. Your real estate agent's commission is not a finance charge. You're paying for their representation of you in the transaction, but it's not part of our process and it's not part of your financing application. We need to take care to make sure that we understand what that is so that we can deliver properly on what we're doing in the transaction, which is providing the funds by way of the mortgage. The APR is exclusively associated costs with financing. Simplest way to put it. How will the buyer paid realtor commission impact QM points and fees? Now we got to get another break here for education. QM, this is qualified mortgage. This is part of the Dodd-Frank Wall Street reform post-Great Financial Crisis. Essentially, they are guidelines that have been set forth that say this is what a qualified mortgage should be, and tied into that are an accounting of the APR, and so that for the protection of the home buyer and the borrower, that borrowers aren't charged exorbitant fees if you have, let's say, an extremely high fees financing, you won't pass QM, qualified mortgage. That's a problem. Fannie Mae, Freddie Mac, Ginnie Mae, Department of Veterans Affairs, the United States Department of Agriculture, these are all different federal places, federal sources for funding for loans. They all set forth these guidelines, and they will not accept that if you're above a certain threshold in the amount of charges for finances. So the finance charges are expressed as an APR. That APR drives whether or not you pass this QM, qualified mortgage test. And as we mentioned before, the answer to this question, will this affect the qualified mortgage points and fees test that happens for every loan? No, because real estate agent commission is not a finance charge. Can the buyer pay the realtor commission fee on a VA loan? The answer for this one is no. So currently, as it stands, the Veteran Affairs guidelines for VA loans, and these again are loans for veterans, so current service members or previous service members for our military and other branches, you cannot pay a buyer's agent commission. So this would require, if you are a veteran, you're obtaining VA loan financing, as it stands now, you would need the seller to pay your agent's commission, and that would need to be negotiated. The thing with this lawsuit is that, to highlight again, the multiple listing service is not supposed to indicate buyer's agency commission, and it is not to be assumed that the seller is going to be paying buyer's agency commission. Now they can. Now a listing agent can make their presentation, and they can have built-in already payment for the buyer's agency commission. That's somewhat business as usual, but it will require a little more coordination for prospective buyer's agents to understand what that commission is. For a VA loan, the borrower themselves cannot pay it, so it needs to come from the seller. Can the buyer finance the realtor commission fee on an FHA loan? So the FHA loan is a different type of loan product that's also guaranteed by the federal government. Now, you cannot finance the commission into the FHA loan. There are other guidelines and things which we're going to get into very briefly, but this is also the case for Fannie Mae and Freddie Mac and USDA. So across the board, it's not just FHA. Any of your conventional loans, that's Fannie Mae and Freddie Mac, FHA loans, or USDA loans, you can't increase your loan amount and finance your payment to your buyer's agent through your loan. Hang with me on this, though, because the next question actually is like, well, the seller could still possibly pay, or you can quasi-finance it if you get something called a seller concession. Now, that means it's still coming out of the seller's side, so technically speaking, it's not financed, but if your down payment is based upon an agreed upon purchase price, and then the sellers are giving you a concession or a credit, and that is going to be used to help you as a buyer pay your realtor commission fee, then it's somewhat financed. You can think of it that way. So in this case, the seller can agree to pay the buyer's agent commission. There's a couple ways they can do that. The first way is the most comparable to the way business is currently being conducted. The seller can set up a separate agreement with the buyer's agent to pay their commission. Simple. That's it. The other way to do it is for the seller to offer a seller credit, a seller concession, or what we also call, and this is the terminology in the mortgage world, the interested party contribution. So all these three terms are interchangeable. I'm just going to use seller credit because it's the most simple and straightforward. But seller credit, seller concession, and interested party contribution, all three of these mean the same thing. So interested party contribution in the respect of what we're talking about is a seller credit. You can have a situation where you have the seller contribute back to the borrower. Maybe it's $5,000, maybe it's $10,000, and that can be used to defray closing costs and prepaids, and in this new world would also include the buyer's agency commission. Now, there's a big asterisk here. There are limits to how much a seller can contribute by way of seller credit, and it varies across different loan programs, different banks, different investors. I don't want to get too bogged down with the nuances of how this can be different. So I thought it would be best for us to just look at what those guidelines currently look like in their current form. And this way you'll get a good sense of what does that mean dollars and cents and how attainable is that. So if you are getting, I'll start off easy. If you're getting an FHA loan, so an FHA loan requires 3.5% as a minimum down payment. And typically that's a better loan product if you have a lower credit score, not all the time, but case by case, we would always look at what your situation is. But by and large, lower credit score borrowers, FHA loans make more sense. They're typically less cost prohibitive. So you have a better deal on your financing. And there's also a little bit more leniency in the guidelines to qualify. That across the board, no matter what down payment you make, you have 6% of the sales price that can be used as a seller credit. So for example, if you are going to buy a home for, let's say, $500,000, and you're going to put 3.5% down. 3.5% down doesn't matter because we're just looking at the $500,000 purchase price. $500,000 down, and you can possibly get up to 6% of that $500,000 back from the seller as a credit. So if a typical buyer's agent fee is 2.5%, let's say, I'm not saying this is the case, just for example purposes, let's say it's 2.5%. Well, you've got 6% there. So theoretically speaking, you can negotiate with the seller, a seller's concession, 2.5% of the sales price, and that money will go toward paying your real estate agent's commission, your buyer's agent, and then the rest of the closing costs and prepaids you pay as you normally would. USDA, second loan, that's simple, is the same. So even though you can have up to 100% financing with USDA in some respects, and these loans are more particular for rural areas, and there's actual geographic areas that you can do USDA loan financing. So you have to be in that market first and foremost, but if that is the loan you're getting, that also has a 6% cap on seller credit. So there we go, yet again, 2.5% will be able to go paid by the seller, and it's done through a seller concession. Conventional is where we start to have some different things going on. And I'll throw in the monkey wrenches now. For conventional loan financing, the seller credit, this is just as Fannie Mae and Freddie Mac have it. The seller credit is dependent upon your down payment as a buyer. So if you have up to 10% down, so if you're putting down 3% up to 9.99999%, you have a maximum seller credit that could possibly be worked out and negotiated of up to 3%. So 2.5% commission, you're good. Now, if you have 10% down to 24.09% down, or 24.39, I think it is. Well, whatever, up to 25% down. Once you hit 25% down, that's a different story. But 10% down up to just shy of 25% down, it's 6%. So just like FHA was, just like USDA. The only difference with conventional that gives you a little bit of an edge is that when you put 25% down or more, now you have up to 9% of the sales price. Again, these numbers are based upon sales price. This was all for primary residence and second home purchases. So if you're buying a new home for yourself that you're going to live in as a primary, or you're buying a vacation home, a second home, these are the guidelines as they stand for conventional loans, FHA and VA and USDA. If you're buying an investment property, regardless of your down payment amount, you are capped at 2% seller credit. So if your buyer's agency is to pay that buyer's agent 2.5%, you would need to come up with another 0.5% if you negotiate a seller concession. I'm talking at great length about the seller concession piece because that's one way that this can get engineered. In my opinion, it seems to me that having the seller work out an agreement to the buyer's agent and have that negotiated there is the preferable route to not encumber the financing process and the mortgage process with other things. And then I'm going to also highlight a couple of pitfalls here if the seller concession route or the seller credit route is the one that's elected. Number one, if the appraisal comes back short. If the appraisal comes back short, in typical course of business right now, the first thing that gets reduced is the seller credit, because now the sellers aren't getting as much if the property gets negotiated downward. Obviously, if you waived your appraisal requirement, meaning that, well, hey, I'm going to submit my offer right now, regardless of what the appraisal says, I am going to pay you, let's call it $500,000. The property comes in at $490,000, you're still paying $500,000. Your maximum seller credit now, though, is based on $490,000. Remember this. And now you've got to proceed in your transaction. Okay, you could be fine. If you have an appraisal contingency, this is where it gets tricky. If you have an appraisal contingency and now you're going to be reducing the sales price, now you're reducing what your maximum interested party contribution, maximum seller credit could possibly be. Quick correction, actually. If the house underappraises, the maximum seller credit is still actually based upon the sales price. So that gets maintained. But if you reduce through negotiation, that's when you run into an issue. And that's where the amount gets reduced by way of dollars and cents. If the percentage remains the same, then the percentage remains the same. It's still 3%, 6%, or 9%, depending on your scenario and loan program. The other thing is, if you're going to use seller credits to pay your buyer's agent commission, but now let's say that there's a bona fide situation with the property. Let's say there's something that you know what? We did the home inspection and we've noticed a couple of things here. If you're not going to repair them, we're going to negotiate and try to negotiate now a credit of, let's say, $3,000. If you've maxed out your seller credit by way of, your negotiations prior to that happening, and now you need additional money, you can't have access to it because the seller credit now will be hitting its limit. So these are just a couple things to bear in mind and why I feel confident, in my opinion, that in the event now where the buyer is not going to be paying, if it does get negotiated, where it's coming from the seller side in any way, I just see the path of least resistance forward and the most likely scenario to be just a separate negotiation of the buyer's agent directly with the seller's agent to have the seller pay their commission and whatever that is and work that out. That's it for me for today. I know there was quite a bit of information here about these different changes and these questions, but I welcome your feedback. If there's anything that you want to know about in particular with relationship to this settlement or in general, I encourage you to reach out. Shoot me an email, find me on socials, or you can, DM me anytime. And I'm happy to answer any questions that you've got. I will be back again on Monday with a mortgage rate update. Just a heads up, it's getting a little tricky, but we'll see. I'll give you guys the latest and greatest on Monday. In the meantime, have an awesome weekend and take good care.